We'll go ahead and get started. Good morning, everyone. This is James Bogart, CEO and founder of Bogart Wealth. Today, we're going to be doing a talk on how does the new tax bill impact my financial plan. We are very fortunate to have Mike Townsend from Schwab. I'm going to let him introduce himself in a second, as well as Patrick, one of the advisors here at Bogart Wealth. Mike, why don't you go ahead and introduce yourself before we get going?
Sure. Hi, everybody. I'm Mike Townsend. I'm part of a little team in downtown Washington at Charles Schwab. Kind of our job to watch what's going on Capitol Hill, halls of Congress, White House, regulatory agencies, and really figure out what it means for individual investors. So I'm really happy to be with you guys today to talk through some of the developments that are going on in Washington. There's been a lot of stuff happening.
Absolutely. Patrick?
Good morning, everyone. Patrick Marcinko, certified financial planner, financial advisor here at Bogart Wealth. I sit in our Virginia office, and I'm very excited to have Mike today to unpack the one big, beautiful bill.
So, to kind of set the stage, Mike, why don't you go ahead and talk to us, like, before the bill, what was the legislative environment like in Washington?
Yeah, sure. I mean, I think, as everybody knows, we've got an all-Republican Washington. So 53-47 is the margin in the Senate. As of right now, 219 to 212. There's actually a resignation that happened in the House of Representatives last week. So when the one big beautiful bill passed, it was 220 to 212 was the margin for the Republicans. And then, of course, the Republicans control the White House. So when you have everybody in one party kind of on one page, and you have control of all three, White House, House, and Senate, it really gives you a lot of flexibility to get legislation through. And I think the important thing to know about the kind of context of how the one big beautiful bill came to be is the fact that when one party has control, they have a special process known as budget reconciliation that can be used to sort of bypass the other party, basically. And what happened in this case was that Republicans had full control. And the main feature of this is that you can pass it with a simple majority in both the House and the Senate. Cannot be filibustered in the Senate, and you only need 51 votes. You don't need 60 vote supermajority. So that's the process that sort of created this big bill. And I want to be clear that the process itself is not weird or controversial or unusual. Democrats used it in 2022 when they had full control to pass the Inflation Reduction Act. Republicans used it in 2017 during the first Trump administration to pass the big tax bill back then. So the process isn't weird, but that's really important to know because it gives the context of why Republicans were able to kind of move on their own without Democratic support on this.
Yeah, and I should add, by the way, we do have the question box open that if there's questions along the way you'd like to ask, we've got the screen right in front of us in order to be able to get those to Mike or Patrick or myself will chime in on. So, Mike, really appreciate the framework of where things were at a macroeconomic environment. Why don't we talk about the bill itself and kind of some of the substance, get into more or less what's permanent, what is temporary. I know we had a nice constructive conversation as we were preparing here. Would love to kind of recreate some of that as we get into some of the nuances that we feel would directly impact the typical client of Bogart Wealth.
Sure. As I mentioned, this is an extension of a bill that passed in 2017 during the first year of the first Trump administration. Big tax bill. But what was unique about that bill is that all of those provisions that passed in 2017 were set to expire at the end of 2025. So we knew years ago that no matter who was in the White House, what the configuration in Washington was, we're going to have a big tax fight in 2025 because of all those things sunsetting at the end of this year. So that was why the bill sort of came to be. And with Republican control, they really prioritized making a lot of that permanent. And that's what happened. So those lower individual income tax rates that have been in place since 2017, those are now permanent. The larger standard deduction, the higher child tax credit, those are permanent. And then the one that I think was really important from a planning standpoint, of course, is the estate tax. The amount that you can inherit that is exempt from the estate tax is going to be $15 million, $30 million for couples beginning in 2026. And then it's going to be indexed to inflation in years after that. So it's in place. We can plan. And as you guys know, the estate tax has kind of bounced around all over the place over the last, 10, 15 years. I think there was one year where we had like no estate tax at all.
Yep.
So this provides a lot of certainty going forward. I think that's really significant.
And Mike, one of the things that, you can see on the slide is that there are a lot of sunsets happening, especially to key components of the campaign promises from this past election. Notably, the sunsets happen in 2028. And so what's your sense for, do you think any of these would be extended and what the appetite would be to walk back some of these after the sunset?
Yeah, so the sort of second part of this bill, right, is these campaign proposals that the president made during the 2024 campaign. No tax on tip income, no tax on overtime hours, making auto loan interest tax deductible. And then the fourth one, he had talked about eliminating taxes on Social Security benefits. However, the rules under which this bill was considered actually prevent you from making changes to Social Security. So that's why they came up with this idea of this special $6,000 tax deduction for seniors 65 and up. And so that's kind of designed, it's not a total apples to apples thing, but it was kind of designed to replace the fact that they couldn't change the taxation of Social Security benefits. So those four all are set to expire in 2028, as you point out. But keep in mind, what is 2028? Presidential election year. And I'm guessing that things like no tax on tip income and a $6,000 deduction for seniors are going to be pretty popular. And in the presidential election year, the chances of those just going away, it seems unlikely to me. We have obviously no idea what the circumstances will be in 2028, but it just feels like those may have a longer life than just 2028. So we'll see.
Sure. Well, and I think realistically, application of this, right? Like how these things get applied and then ultimately the prevalence going into an election year, as you mentioned, I think is going to be a big part of the decision to extend them. So, Mike, many of our clients are charitable and estate planning is a very common topic. Could we touch on some of the main points around the SALT deduction and then as well dive into charitable as well as estate planning independently?
Sure. The SALT deduction, the state and local tax deduction, was one of the weirder kind of aspects of this bill. So folks may remember that the SALT deduction was capped at $10,000 back in 2017. Well, for a handful, and I really mean like 5 members of Congress who represent high tax locales in Southern California, New York, and New Jersey in particular, this was really, really important to them to get that deduction increased, that cap increased. And because there were these kind of 5 members of Congress, and because the margin is so narrow for the Republicans in the House, 5 votes mattered. So these 5 had a lot of leverage, and they really wanted to get that increased. So they negotiated. And the odd political dynamic about it, of course, is that, Congressman so-and-so from Oklahoma does not care about this at all. Doesn't affect any of their constituents. So it really was a small group. They ultimately got this bumped up to $40,000. That's in place for the next 5 years. It's a pretty significant increase. So that was the result of that change. And then I think we have some stuff on the next slide around the charitable thing, because there are some important developments on the charitable side. One is that there's a new $1,000 charitable deduction for people who don't itemize their deductions but make charitable contributions, $2,000 for couples. Pretty significant. I think that's a real positive in the bill. This actually harkens back to something that was in place during the COVID years temporarily. Yep. There was a little deduction that was put in place those years. So this kind of renews that and makes it permanent. On the sort of negative
and real
side,
to emphasize that's for the non-itemizers.
Yeah, non-itemizers. Then for itemizers, there's a new floor essentially for charitable giving that basically disallows the deduction until you get up to 0.5% of adjusted gross income, AGI. And that is an interesting one. You guys have probably started to think about this a little because in my mind, what it does is sort of push people towards maybe larger, less frequent charitable contributions rather than more frequent, smaller ones. It's going to be interesting to see how that one plays out.
Yeah, and candidly, that's one that really is going to emphasize using vehicles like donor advised funds, where you do a larger gift into the donor advised fund to facilitate the smaller ones. But that way, we're breaking or getting over that floor that's being implemented here.
Yeah, I think that's absolutely right. That's the kind of strategy you want to be thinking about here. I'm not totally sure what the policy incentive behind that decision was, and we'll see whether that gets looked at again, because it was a little bit of a surprise coming out of the bill. One of those things in the 1,000-page bill that just kind of crops up. You're like, whoa, okay. So.
Well, and we should have probably mentioned it at the beginning, but the reality of it is there's a lot of this bill that we're still learning about, and learning some of the nuances of the different elements of the bill as well.
Yeah, and I'll just add to that the IRS has a ton of work ahead of it, because as typically happens, Congress sort of puts out kind of a general idea, and the actual mechanics of implementing some of these things ultimately will be left up to the IRS. Because a lot of them are effective for this tax year, the tax year that we're in, 2025, there's going to be a real scramble to get things thought out and get those forms ready for the upcoming tax season.
One of the policies that is included in the bill that we seem to have a little bit of uncertainty about is the Trump accounts. And so could you talk to our group about what we know about the Trump accounts so far and kind of how they're supposed to be structured?
Yeah, so these accounts are designed for newborns, essentially. So basically, it's $1,000 put into a brokerage account for a child born 26 through 28. And it's a straight up free $1,000. So that makes a lot of sense. However, the way the accounts are structured, and I'll be honest, we're still learning a lot of the details too, and a lot is going to depend on how the IRS puts things together. But there's not, to me, a lot of real tax incentive to use these accounts, because there's no real incentive to put money in. You can put up to $5,000 in per year as a family member to these accounts, but you don't get a benefit for doing. There's no tax write-off for doing so. And then on the back end, they're treated as capital gains, taxed at the capital gains rate that have happened over time, even if you use them for something like education or other specified expenses. So to me, that doesn't compare favorably with a 529, for example, college savings plan. Mm-hmm. And so, there's a lot of details that are still going to have to be worked out. But the my initial take is I'm not sure that these are going to be more attractive than some of the existing vehicles.
Yeah, I mean, truthfully, I think the only benefit that might manifest is if an employer actually contributes to these, because the employer can contribute up to $2,500 into these. That's probably, in my opinion, the only benefit to the individual themselves, right? I mean, it's free money from an employer if an employer decides to opt in on them.
Yeah, and I think it'll be interesting to see over time, does that become kind of a competitive thing for employers, right, from a benefit standpoint? We'll have to see what the take-up is on that. So I think there are a lot of questions still to be answered. Frankly, there's a lot of questions in the business side of trying to how these are going to be structured, how they're going to be invested, all that sort of thing still has to be worked out.
Mike, is there anything else on this slide? And then we've got a couple others to continue on before we get into some of the questions and legislative outlook.
Yeah, there are, the bill ends a lot of the green energy tax credits that were put in place a few years ago. From an individual standpoint, the one that's probably gets the most attention is the $7,500 credit for the purchase of an electric vehicle. That actually now expires on September 30th. So I don't know, I guess if you're in the market for an electric vehicle, it's probably a good time to go find one. There's also one for energy efficient home improvements that expires at the end of the year. And then I think the other really important aspect of this bill is the fact that it increases the debt ceiling by $5 trillion. And what that does is it takes away those kind of every other year or so we have a big fight in Congress over raising the debt ceiling. we get on the precipice of potentially defaulting, and the markets historically just don't like that. There's a lot of volatility around that uncertainty. This takes that off the table. The next time this will probably come up, I'm thinking mid to late 2027. Of course, a new Congress will be in place, so this basically kind of kicks it off to the next Congress. The downside of that is it allows more debt to be accumulated, and I think we're seeing in the bond market growing concern about the U.S. fiscal picture, the continued growth of budget deficits and the debt, which this bill will continue to do. So there's a little bit of a sort of, I think in the short term, the market, equity market in particular, is happy that we don't have drama around the debt ceiling. But I think the bond market, looking at the much longer picture, is growing concerned about the direction we're headed on the debt side.
Would it be fair to say that this was a bet on growth? That a structured tax environment, the way that we've done with the one big beautiful bill, is them anticipating more economic activity that's going to offset this?
Sure, and you are probably aware that this is always true. When Congress makes these big legislative decisions, there's always these what have proven to be very aggressive and hopeful bets on economic growth that historically haven't panned out. And so we'll see. Maybe this one will. But the projections are that this is going to add to the debt, and that the growth may not be as robust as hoped. We'll see.
Yeah.
And Mike, one of the components to that, extending the debt ceiling, likely related to the slim majority that the Republicans have in both the House and the Senate. And how do you think that narrow majority affects legislation going forward into the midterms? And do the looming midterms have any impact on what's coming up on the horizon?
Yeah, look, I think this is, we're already in the midterms, right? This is going to be the fight over the midterms is this bill, because frankly, I don't think we'll see anything near the significance of this bill happen legislatively the rest of this year or next year. It gets really hard to pass big legislation when you have a midterm election year. So getting this done, obviously a huge accomplishment for the Republicans and the administration. Now we have a big battle coming over the sort of messaging of this. The polls early have not been good on it, but I do think that a lot of people don't understand what's in it. It's going to be incumbent on Republicans to articulate that and to kind of sell it. Democrats, of course, are eager to harp on things like the Medicaid cuts and food stamp cuts and the
green
debt
energy cuts,
impact.
yes.
And yeah, so that's going to be what I think the next 18 months are going to be really a battle over what this bill means, and we'll see.
So Patrick, the number one question we're getting is, how does this actually impact my financial plan? And Mike, I'd love for you to obviously chime in on this as well, but can you give a little bit of commentary there?
Absolutely. And, I think anytime we have a legislative change like what we've just had, it's always a good time to review a financial plan. But notably, with the passage of the One Big Beautiful Bill, we want to really be thinking about where is income projected to be from a tax planning perspective, because as Mike talked about at the beginning, a lot of the features of the bill have phase outs to them. And we want to make sure that as we're thinking about planning opportunities for not only this year, because Mike, as you also noted, a lot of the bill is in effect for 25 as well. Are any of the actions that we're taking going to have a ripple effect? And we talked earlier, or before we started, about, how do Roth conversions impact the senior credit, because there is a phase out limit for the $6,000 senior credit. And so I don't know if you have any thoughts on the trade-off there, but that's a question we now have to face.
It's certainly another modeling. And to give a little more color to what Patrick was talking about is the additional $6,000 senior credit that kicks in at age 65. It has an income phase out for married households, starts at $150,000. And Mike, correct me if I'm wrong, but I think it completely phases out at $250,000 of income.
I think that's right. Yep.
The point that we're making is for any of the households that we're working with where we see a clear and definitive need to do Roth conversions to manage future required minimum distributions, but also simultaneously looking at wealth transfer and legacy transfer conversations. I think it's important to emphasize that $6,000 is a above the line deduction, right? It's not a tax credit. So the economic implications here that we're talking about may or may not be economically significant. And I think the onus is on us as the advisors to demonstrate the difference in the outlay, like, doing the conversion versus not doing the conversion. I think the key takeaway is, for anyone that obviously is working with us, we need to revisit the plans, and we've already been sending that messaging out. And anybody who's not working with us, you absolutely need to have an advisor who is looking at this stuff proactively. And what are the implications, not only in 2025, but 2025 and beyond? Anyone's plan, the manifestation of the value isn't necessarily on any one particular year. The accretive benefit typically happens many years from now, right? And so when I think about, for example, we'll just use Roth conversions because that's what we're talking about. We're actually having to spend money now in an increased tax bill earlier on in order to have the benefit of lower required minimum distributions, sometimes tens of years in advance. So it's not something that we're always going to manifest the benefit on in one particular year right now. Anything else you wanted to add to that? Or Mike, anything you wanted to chime in on that?
Mike, anything for you?
Yeah, I'll just add, one thought here is one of the notable things of that, many of these provisions are permanent, right? Now, the word permanent in Congress is, has a very different definition than what most people think of as permanent. But the difference between these being permanent and what happened the last time, 2017, where you had a sunset in 2025, a sunset is very easy from a political standpoint to let expire, right? You don't have to do anything. It just goes away. A permanent thing, you have to actively change. So that means in the future Congress is going to have to actually vote to raise taxes, for example, on those individual income tax rates. So I just note that because that's a really significant difference politically, is having to proactively vote to increase something as opposed to kind of, looking aside while something goes up without your vote. So
let time expire.
Yeah.
Well, and admittedly, that was one of the questions I already saw came in is permanent really permanent, right? Because let's just say we see political parties change in the midterms or even in 2028. Yeah, of course. But to your point, Mike, it's that it requires a vote in order to actually make substantive changes going forward for many of the items that are not sunsetting.
Yeah, and James, probably the most common question I also am getting is around that. And, you have to say, sure, a future Congress could, change all this, right? Democrats come into power, they're going to have different priorities. They're probably going to go after the highest tax bracket, as they've talked about, but when is that going to happen? I think we're a couple elections away from even really considering a full Democratic control. So you just don't know the time. But yes, permanent is a very fungible word in Congress.
Yeah. Couple takeaways here, right, from the bill. And then I want to talk a little bit about the Fed, if that's okay with you, Mike.
Yeah, absolutely. I think I've hit on most of these. I do think it's a big win. Look, the president got most of what he wanted. And to somewhat, I will freely admit to being pretty surprised that he got it done by his deadline of July 4th. Even a month or so before, I would have said that seemed unlikely. But I think the president showed that he can twist arms, that he can get things done, and there's no way to look at this other than a big win, I think, for the president. As I said,
I actually heard you present a month before, and you were very skeptical that this was going to get done in a near term.
Yeah, exactly. So, as I said, creates certainty in a lot of areas on taxes, but certainty is, as we were just talking about, a moving target. I think that the third bullet there is a notable one because it just seems like nobody cares about budget deficits and national debt anymore. There are a group of Republicans who had never in their careers voted for a debt ceiling increase until now. So even the true fiscal hawks ultimately sort of folded on this one. And, I don't know what that means for the future, but I think we all know that the direction of the debt is not a good thing. And there just doesn't seem to be a lot of energy to deal with it. And then, as I said, I really think there's going to be a big messaging battle over the next 18 months that's really going to go all the way up to the midterm elections about the impact of this bill and on people's lives. And that's going to be the heart of the political fight.
Yeah. All right. So we've got the Fed meeting tomorrow. Can you talk a little bit about legislative agenda there and really kind of what's next in Washington?
Yeah, first on the Fed, look, I don't think we expect, or anybody really expects, any rate change to come out tomorrow. I think what is going to be really interesting is what Powell says in his news conference. Does he signal that a rate cut is coming in September at the next meeting? And I wouldn't be surprised if he sent some signals in that direction. We're still in the kind of 1 to 2 cuts this year. I could see a sort of September and maybe one more before the end of the year. But I always say anyone who says they have a crystal ball on the Fed, they don't. It's very data driven. Obviously, the other big Fed thing is this kind of constant back and forth between the president and it's really kind of, I guess, a one-way conversation with the president towards Jerome Powell. I don't think the president is going to fire Jerome Powell. It's certainly not clear legally that he can do so. Frankly, I think he kind of enjoys the trolling aspect of it. And, as we know, Powell's term ends in May of 2026. The president's going to pick the nominee for the next chair. I think he can wait it out. I do think we'll see a lot of social media posts, sort of badgering the Fed into lowering rates. But keep in mind, the chair can't magically lower rates by himself, right? There's 12 voting members of the FOMC, and, they have all their different views. So that's the Fed. The other big one I think that everyone is paying attention to is tariffs. We've got a big deadline coming up at the end of this week where the president has threatened to raise tariff rates on a whole bunch of countries. We've certainly seen some notable agreements, Japan and EU in the last few days. I think that's very, very significant. But, I don't know what you guys think, but the market reaction since April, I mean, obviously we had the big shock to the market in early April. But since then, S&P 500 is up 28%. And it doesn't feel like the market is going to have a big reaction to whatever happens on August 1st, that the market has kind of settled into, we're going to have this element of uncertainty about what tariffs are going to be. And companies are trying to figure out how to deal with it, but the market seems to not be overreacting. But James, I don't know if you have a take on that.
No, I think you're spot on. The markets have shown a tremendous amount of resiliency. We came into 2025 saying it was a year of change, and at one point, our uncertainty had uncertainty, and the markets were processing it. But I think now, on a relative basis, the uncertainty is so much less than what it was earlier on that the market's just more or less taking it in stride. I'll be the first to admit I'm surprised that the S&P has performed the way that it has. The real question I have, and I know it's not really topic for today, is around earnings, because the tariffs are presenting a tremendous amount of uncertainty with corporate earnings. Did we see an acceleration of spending both at the individual and corporate levels with people trying to get ahead of tariff price increases? And is that going to continue on through the back end of 2025 and into 2026? That's the real question that I think everyone's trying to answer here. And I think that's the kind of external implication associated with the uncertainty around tariffs right now.
Yeah, I absolutely agree with that. I think that's the thing to watch. It's the fact that we haven't seen a big inflation impact, but inflation's creeping a little bit. Are we just delaying that? Is that still a big worry as we head towards the end of the year? I think that's an unknown. I certainly saw the headline was it General Motors that talked about. They lost $1 billion basically, and that's not a sustainable path. So So we'll have to see. But I think there's still more to be written here on the tariff impact. It's just coming slower than I think a lot of us anticipated.
Well, and the ripple associated with, like, take U.S. companies, a lot of the parts made for U.S. produced goods are made overseas, and those are being impacted by the tariffs. Like, again, I think of the auto industry as the prime example here. It's like, there's no doubt in my mind prices of cars are going to go up, period, the end, right? Like, and it's simply because what goes into those cars is increasing in price because of the tariffs.
One other thing to say on tariffs, because I've been getting this question a lot, there are a bunch of court cases out there, and there's a notable one this week. In May, the Court of International Trade ruled that most of the tariffs were unconstitutional. The Court of Appeals paused that and said the tariffs could continue while the appeal is happening. Well, the oral arguments on that case are Thursday, on July 31st. And presumably the appeals court will rule sometime, in the early part of the fall. I think almost no matter what happens, it goes to the Supreme Court. But there's an important thing to know here, that the court case is about the mechanism that the president used to impose tariffs. It's not about sort of whether tariffs are good or bad.
Yep, sure.
So even if the courts were to throw out the mechanism, there are other options that the president has at his disposal to impose tariffs. So, I get a lot of questions about, well, won't the courts just make this go away? I don't think that's likely. The courts may, give the administration a win or a loss on the particular merits of the case. But even in that case, there are options for tariffs to continue.
I wanted to kind of wrap up our slides because we had a lot of questions come in, if that's okay with you. I know this was one that you wanted to hit too, Mike.
Yeah, I end all my client presentations with this slide. And what you're looking at is, I freely admit it's kind of a goofy slide, but it's a great illustration. Basically, what this says is, if you had invested $10,000 in the early 1960s and only kept it in the market when a Republican was in White House, you'd have about $100,000 today. If you only kept it in the market when a Democrat was in the White House, you'd have a little more than $600,000 today. But of course, if you kept it in the market the whole time, regardless of who was in office, you'd have about $6.4 million today. I use this to remind clients that this is a really emotional time for a lot of people. You may be really happy about what's been happening over the last 6 months. You may be really horrified. Maybe you're looking at property in Portugal, or whatever it is that you think about what's going on. All those emotions are really bad mix with your investing decisions. And so this is a reminder not to make investing decisions based on sort of political things that are going on. The market typically doesn't really care a lot about who's in charge. I would say the last 6 months, we've seen more direct kind of connection between Washington policy decisions and market reaction than usual. But I feel like that's kind of fading, and we'll kind of get back to normal, which is that the market typically doesn't care that much about what's going on, politically in Washington. So I just try to remind people to not let their emotions get in the way. And if they are feeling emotional about their investing, great time to talk to you and your team. So
I think we actually used this exact slide in one of our monthly calls earlier on in the year as things started amplifying. And you said it well. It's historically speaking, it's proven better to stay invested versus trying to time the market in any context, but especially with regards to politics. Yeah. We had a lot of questions come in. I wanted to make sure we had the ability to hit some of these. Can you scroll to the top and we'll just kind of hit them down? Do you want to read these off for us?
Sure. So one of the ones that I think we should start with is Social Security and Medicare, major talking points throughout the campaign. What is directly associated to these in the bill? Did anything talk to these directly? I mean, we talked about the senior tax kind of credit and deduction, but that's not a direct correlation. Is there anything that we need to be watching out for?
Yeah, Social Security is a question I get all the time. And really, in the One Big Beautiful Bill, they just didn't have the ability to really touch Social Security. But I think everybody knows about the sort of fiscal issues that loom with Social Security. Right now, the estimates are around 2033 or 2034 is the year when, if nothing changes, then that's the year in which Social Security will no longer be able to pay out full benefits. I think the estimate is at that time it'd be about 77% benefits.
Yep.
I think everybody on Capitol Hill knows that, we're not going to get to that point. We've got to do something about it. The problem has been, not only recently, but for 25 years, that all of the things that you can do about Social Security are sort of politically bad, right? They're tough votes. You can raise the retirement age, you can cut benefits, you can raise the amount of income that's taxed, you can raise the tax rate, et cetera. Those are all hard things to do. Everyone knows that they're going to have to do them at some point. I think in terms of timing, we're probably looking out a few years, maybe after the 28 presidential election. I certainly think before the end of this decade, you're going to have to take some steps. And I have no idea exactly what's going to happen, but I'll tell you guys, if you just raise the amount of income that is subject to the payroll tax, you can solve this problem for decades. And I would not be shocked if that's where we ended up.
Well, and we've already seen
5 years from
Medicare.
now.
That's already happened on Medicare, the Medicare side. So that's almost the easy one. Yep. By the way, this is analogous to the Reagan administration, where it was the same commentary, same conversation, same funding components for Social Security. It's most likely, I agree with you, it's going to be probably back end of this decade before we see substantive level of change. And yeah, the estimate is if you just increase the wage base or eliminate it altogether, 83% of the funding gap gets resolved just with that, right?
Yep.
All right, Patrick, I want to hit these questions.
Yep. So we talked a little bit about kind of permanent versus temporary and what that means. Can you recap for us, because this is just such a big one, what the income limitations are for the senior deduction and kind of how that's going to work for folks that have higher incomes?
Yeah, so the senior deduction is $75,000 for individuals and $150,000 for couples. It starts to phase out and sort of goes down a little bit as you go up income from there until it eventually phases out completely. So, and then the other thing is that is in place for this year, 2025 through 2028. So it's a 4-year provision. And as I mentioned earlier, we'll see what happens in 2028. I have a hard time imagining in an election year that this would just be allowed to expire. But we'll have to see what the political circumstances are down the road.
Mm-hmm.
We had a question at the end. Will we be posting this? Yeah, this is actually being recorded, and we'll be distributing it as well. Another comment about charitable deduction thing has potential to have a massive impact on 501c3 organizations. Potentially. Mike, you kind of gave a little commentary there, right? Like it for those that are that are standard deductors that actually could benefit charities, right? Where you're getting the $2,000 above the line deduction, but it's for the itemizers that are doing a lot of small ones, maybe, but. Like I mentioned earlier, I think if we utilize vehicles like a donor advised fund to allow for the normal monthly distribution, monthly donations that happen, I think we're not going to see material substance. I agree with Mike. I don't understand the policy of why they did that, but yeah, it is what it is.
Yeah, I do think that charities are worried about it as they look at this. They're not going to know for probably a year, 2 years, what the impact is going to be. But I think they're worried about that floor disincenting some charitable givers. We'll have to see. Hopefully that's not true.
Would that be something if it does have a detrimental outcome? Is that easy for them to remove the floor?
Yes, I think that's something I would watch, down the road a year or two. Charities are powerful, in their communities. And if charities are seeing the numbers go down, it's really easy to talk to your congressman who probably is familiar with the big charities in his or her district and really push to get that change. So I think that's a real possibility.
I'll let you read this question.
So we got a question that's got a couple different parts, but one of the components to it is, as we think about estate tax, they raised the estate tax kind of exemption limit. Are there any other items? It doesn't look like the step up in basis made it into the bill, but anything else from a estate perspective that is notable in the one big beautiful bill?
Yeah, the step up in basis was not changed or anything like that. And that's one I get asked about a lot. It's a really hard one for me to imagine getting changed. However, it's a big number in terms of revenue if that was to change. And so that's why it's always sort of on the table, always kind of being talked about. It has a real change the game in the middle, change the rules in the middle of the game kind of feel to it that I think would be a really difficult sell to voters. But it's something I think we always have to be kind of on the lookout for. But no, there was no big change there. The other one that has been getting some attention recently that just came up because the president mentioned it is changing the amount of income from house sale that is subject to capital gains taxes. That was not included in this bill, but the president has now kind of floated it out there as something that he wants to look at. So that could be something that comes, in a future bill in the next, 18 months. We'll see.
And part of that kind of follow-up question that we were asked talked about Roth conversions, and we talked a little bit about that and the factors. But one of the things that we didn't really see much in the big, beautiful bill was backdoor Roth contributions or mega backdoor. It doesn't seem like there was any sort of Secure Act 3.0 or any legislation that got into this bill as it relates to those retirement accounts.
That's right. And there really wasn't much at all that impacted retirement accounts in particular in this bill. I do think there is some energy around a Secure 3.0 type bill. But, given the size and scope of this bill, sometimes it's hard to kind of gear up again for another big thing. So I don't know that I anticipate that being super high on the priority list. But again, we'll see.
So one of the items that came through, kind of shifting gears, you talked about how both political parties don't seem very focused right now on the debt ceiling. I mean, at what point do you think that comes into focus and we pursue meaningful legislation around that?
This is the question I get all the time, and I get accused of being depressing when I answer this. But I will date myself by saying that I started my career here in Washington more than 30 years ago as a Senate staffer. And at the time that I was a Senate staffer, the national debt was $4.6 trillion. And everyone said, well, it'll never get to 10. Congress will do something about it. Then it was 15, then it was 20. Well, it's currently a little over $36 trillion. And with this bill permitting it now to go north of $40 trillion over the next couple of years. And, one of the things I say all the time is that $36 trillion or $40 trillion, it just sounds like a made up nonsense number to the ordinary person. Most people have no idea how that affects them or why they should care. And the result of that is that there just isn't much political pressure that's put on members of Congress to really address it. People are protesting about everything these days, but not really about the debt. And so I think that's one of the reasons people just don't really make a connection. And, we continue to have the most liquid bond markets in the world. The treasuries, continue to be incredibly important to the world. And so, foreign countries are continuing to buy our debt. We've been having our eye on Japan and China, numbers 1 and 2 in purchasing our debt. That's a lot of leverage for them. They haven't really changed a lot in recent auctions. So all that is to say, we're worried about it, yet, in this sort of short term, I guess not really worried about it. And I just don't know what it's going to take. I mean, the choices for Congress, they're hard. You got to raise taxes on somebody, you got to cut spending more, some combination of those. And if you're going to not address big things like defense and Medicare, there's not a lot of spending left to cut because those are the big ones. So the other thing I'll just say that we're watching is interest on the debt has become the second largest expenditure of the federal government. In the last year, it's passed both defense and Medicare. It only trails Social Security. That's an issue. We're spending more than $1 trillion a year on interest on the debt. And I think Congress is going to have to take a look at that. But, the sense out of this bill was that there's not a big priority to do it. So we'll see.
We got a lot of questions, so I want to be sensitive here. Why don't you keep going?
So you talked about, raising taxes. One of the things that we saw, extended through the TCJA here is the corporate tax rates. And so we got a question, are the corporate tax rates that are set in the One Big Beautiful Bill also permanent, as you defined earlier?
Yeah, so the corporate tax rate is set. They didn't change the sort of base corporate tax rate in this bill. And that's a place that could be changed down the road. That's a little politically easier than individual side. But nothing big changed in this bill. There were a bunch of business tax provisions around certain deductions that were updated in this bill, but the baseline corporate rate was not changed.
Perfect. There was a question that came in on if you had net unrealized appreciation stock or NUA stock, did the Big Beautiful Bill change how capital gains are taxed when you sell the NUA stock?
Ooh. I'll confess to not knowing the answer to that exactly off the top of my head, so I don't want to mislead anybody. We'd have to look that one up.
Yeah, and happy to research it, but I would tell you from our impression, no, because capital gains rates themselves didn't change, and I don't believe there was any specific provision talking about the tax code for NUA stock. But we'll respond to that question directly as well.
We also got a question about, or we've gotten a lot of questions and conversations and in the chat about the car deduction, the new car deduction. Can you talk a little bit about that, whether that applies to paying in cash versus financing? Are there limitations to that? That's a popular one.
Yeah, so there are limitations. So first of all, the car has to be a U.S. new car, U.S. built new car. Now, that alone, defining what that is going to be a little bit tricky because, of course, as we know, the global supply chain for the building of cars. So exactly how that's going to be determined, I think, has to be still finalized. I think that there's some language around it has to be finished in the U.S. and a certain percentage of U.S. parts and all that sort of thing. And then that does have an income limit. Off the top of my head, I can't remember if it's 75 and 150, but it's something like that. But there is an income limit to that to that deduction.
I
have it on one of my cheat sheets here, but it'll take me a minute to find it.
So one of the other parts of this is you talked earlier about the SALT deduction, and it's a major change because it will allow, I think, for a lot more people to at least evaluate itemizing. Can you talk about kind of how impactful that may be across the board? I know there's a handful of states that might be more impactful than not.
Yeah, I mean, I think it's limited to, people in high tax sort of areas. The data shows that there's just a lot of parts of the country where, just doesn't really affect many people at all. But yeah, it's a pretty significant jump from 10,000 to 40,000. There is an income cap at 500,000 in income. And then it goes up for the next 5 years. It'll go up by 1%. Both the deduction amount and the income cap will go up by 1% for the next 5 years, and then it expires in 2030. So it'll have to be addressed again after 2030, and we'll see what Congress does at that time about it.
But I guess ultimately the phase out, it can't go below 10,000. So if you're a higher income household where that phase out starts to kick in. It's currently headlined at 40, but what's the number, Mike? It's 600,000?
The income is 500,000.
500.
Yeah.
Thank you.
Yeah. But you're right. So it's not like it goes to zero. That's an important aspect of it. That baseline stays.
Yeah. So 500 down to 600, and then it goes away. If you're at 600, it goes down back to 10K, right?
I think that's right. Yeah.
Yeah. Okay. What else we got? Sensitive on time here.
I think those are all the big ones.
Those are all the big ones. Mike, anything else you want to add to kind of summarize up or wrap us up?
No, I think there's a lot that we're all still learning about how this bill is going to work. There's a lot that the IRS is going to have to clarify through regulations and guidance. And as I said, I think it's going to be a scramble for them to kind of get everything ready for the upcoming tax year. It is fairly unusual historically to have tax changes that are retroactive to the beginning of the year in which we're in. that are as significant as some of these. So that's a little bit of an anomaly, and that I think is going to make it tough on the IRS. So I think we're going to learn a lot about the specific details on some of these provisions over the next 3, 4, 5 months before the end of the year. So with that, though, I'm just really grateful for the opportunity to chat with you guys. Really enjoyed it, and I hope everyone has a great rest of their summer.
Yeah, thank you, Mike. Really appreciate having you as a resource. Patrick, I appreciate you helping chime in. This is a presentation that we did kind of ad hoc based on the opportunity. Really appreciate you all joining us. Follow us for the latest content and upcoming webinars, as well as our podcasts. Please feel free to use this as a resource for any of our clients. Each of our advisors, respectively, are available in a resource in order to be able to help answer any direct questions as well. So otherwise, have a great rest of the summer, and thank you for joining.